I'm sure you've heard the news. Inflation scares a lot of people. They see prices going up and worry about their money losing value. But the rich, they don't fear inflation, they understand it. They know how to protect themselves and even profit from it. You see, the rich think differently about money. They don't work for money, they make their money work for them. And they do that by owning assets. The middle class, on the other hand, often get stuck in the rat race. They trade their time for money and then watch as inflation eats away at their hard-earned savings. But it doesn't have to be this way. You can learn to think like the rich, you can learn to protect yourself from inflation and build a secure financial future. It starts by understanding what the rich invest in and why. The rich invest in assets. They understand the importance of putting their money to work for them, rather than just working for money. This is a fundamental principle that separates the wealthy from the rest. Assets are things that put money in your pocket. They generate income, appreciate in value, or both. This continuous flow of money is what builds and sustains wealth over time. Think of it like this. An asset is like a fruit tree. You plant it once and it keeps giving you fruit year after year. The initial effort and investment pay off continuously. You plant it once and it keeps giving you fruit year after year. The tree grows stronger and produces more fruit as time goes on, just like a well-chosen asset. What are some examples of assets? There are many types, each with its own benefits and risks. Businesses, real estate, stocks, bonds, commodities, and more. Each of these can be a powerful tool in building wealth, and precious metals like gold and silver. These have been trusted stores of value for centuries. These are the things that tend to hold their value or even increase in value over time, even when inflation is high. They act as a hedge against the eroding power of inflation. Why do these assets protect against inflation? It's because they have intrinsic value that isn't easily diminished by economic fluctuations, because they represent real value. Tangible assets like real estate and precious metals have a physical presence and utility that money alone cannot provide. A business produces goods or services that people need. Real estate provides housing. These are essential needs that maintain their value. Gold and silver have been valued for centuries. They are universally recognized and accepted as a form of wealth. When inflation rises, the prices of these assets tend to rise as well. This makes them a reliable store of value. So, while your money might buy less at the grocery store, the value of your assets is likely growing. This growth helps to offset the increased cost of living, preserving your purchasing power. Real estate is a favorite asset of the rich, and for good reason. It's a tangible asset, meaning you can touch it. It's also a necessity. People always need a place to live. When inflation goes up, so do rents. This means that if you own rental property, your income increases, protecting you from the rising cost of living. But it's not just about rent. Real estate tends to appreciate in value over time, especially in desirable areas. So, you're not only generating cash flow, but you're also building long-term wealth. Now, I know what you're thinking. Real estate is expensive, and you're right, it can be, but it's more attainable than you might think. There are ways to get started with real estate investing, even with a small amount of money. Here's something most people don't realize. The rich don't play by the same tax rules as everyone else. They have access to a variety of legal tax strategies that allow them to minimize their tax liabilities significantly. They use legal tax strategies to reduce their tax burden and keep more of their money. These strategies are often complex and require a deep understanding of the tax code. One common strategy is to invest in assets that offer tax advantages. This includes investments in real estate, stocks, and other financial instruments that provide tax benefits. For example, real estate investors can deduct expenses like mortgage interest, property taxes, and depreciation. These deductions can significantly reduce their taxable income. The rich also understand the difference between earned income and passive income. This distinction is crucial for effective tax planning. Earned income is what you make from a job, and it's the most heavily taxed form of income. It's taxed at a higher rate because it's considered ordinary income. This is the income most people are familiar with, and it's subject to the highest tax brackets. Passive income, on the other hand, is money you earn from assets like real estate or dividends from stocks. This type of income is often more favorably taxed. This type of income is often taxed at a lower rate. By focusing on generating passive income, the wealthy can significantly reduce their overall tax burden. By understanding and utilizing these tax strategies, the rich are able to keep more of their wealth and grow it faster. This knowledge allows them to play the game smart and stay ahead financially. It's not just about making money, it's about keeping it and making it work for you. The rich invest in their financial education and seek advice from experts to stay informed about the best tax strategies. They attend seminars, read books, and continuously educate themselves on the latest tax laws and investment opportunities. This proactive approach helps them stay ahead of the curve. By working closely with financial advisors and tax professionals, they ensure that they are always in the best possible position to maximize their wealth and minimize their taxes. Ultimately, playing the game smart means being informed, proactive, and strategic about your finances. It's a mindset that anyone can adopt to improve their financial situation. 5. Your turn, building your fortress. You don't have to be rich to start thinking like the rich. The journey to financial independence begins with a single step, and that step is changing your mindset. You can start building your own financial fortress today by taking these steps. 1. Educate yourself, read books, attend seminars, and immerse yourself in the world of personal finance. Learn about investing, tax strategies, and how to manage your money effectively. Knowledge is power, and the more you know, the better decisions you can make. 2. Change your mindset. Stop thinking like an employee who works for money and start thinking like an investor who makes money work for them. Look for opportunities to acquire assets that can generate income. 3. Start small. You don't need a lot of money to get started. Begin with what you have and grow from there. Even small investments can grow over time with the right strategy. Begin by investing in your education and understanding the basics of finance. Once you have a solid foundation, explore options like low-cost index funds, which are a great way to start investing with minimal risk. Index funds allow you to invest in a broad range of stocks, spreading out your risk and increasing your chances of steady growth. Or consider crowdfunding platforms for real estate, which let you invest in property with a small amount of money. 4. Take action. The most important step is to take action. Don't just plan and dream. Put your plans into motion. Don't wait for the perfect time. The best time to start building your financial future is now. Procrastination is the enemy of progress. The sooner you start, the more time your investments have to grow. Remember, building wealth takes time and effort, but by taking action and making smart financial decisions, you can create a secure future for yourself and your loved ones. You can protect yourself from inflation, market volatility, and other financial uncertainties. Achieving financial freedom is a journey, but with determination and the right strategies, you can build a fortress that stands the test of time. Gold and silver, ancient protectors. Gold and silver have been valued for centuries. They've been used as currency, jewelry, and a store of value. Why? Because they're scarce, durable, and universally recognized. In times of economic uncertainty, like when inflation is high, people often turn to gold and silver as a safe haven. This is because their value tends to hold up better than paper money, which can be printed endlessly by governments. Now, I'm not saying you should put all your money into gold and silver, but having a portion of your portfolio in these precious metals can act as insurance against inflation and economic turmoil. Think of it like this. Gold and silver are like the bumpers on a car. You hope you never need them, but you're glad you have them when you do. 7 commodities, riding the wave. Commodities are raw materials like oil, natural gas, wheat, and copper. These are the building blocks of the global economy, and their prices can be greatly affected by inflation. When inflation rises, the cost of producing and transporting these commodities goes up, which often leads to higher prices. This can benefit investors who own commodities or commodity-related assets. Now, investing in commodities directly can be complex and volatile, but there are ways to gain exposure to this asset class through ETFs or exchange-traded funds, or mutual funds that specialize in commodities. By diversifying your portfolio with commodities, you can potentially benefit from inflation and protect your purchasing power. 8. Education, your most valuable asset. The best investment you can make is in yourself. Investing in your education doesn't just mean going to college. It means constantly learning and growing, especially when it comes to personal finance. Read books, attend seminars, listen to podcasts, and seek out mentors. The more you learn about money, investing, and building wealth, the better equipped you'll be to navigate the challenges of inflation and achieve your financial goals. Remember, knowledge is power. And when it comes to building wealth and securing your financial future, knowledge is your most valuable asset. 9. The clock is ticking. Act now. The year is 2025. The decisions you make right now will determine your financial future. Inflation is a silent thief, eroding the value of your hard-earned money. Don't wait until it's too late. Don't let fear paralyze you. Take action today. Educate yourself, change your mindset, and start building your financial fortress. The rich understand that the time to act is always now. They don't wait for the perfect opportunity, they create it. Follow their lead, take control of your financial destiny, and secure your future. The clock is ticking. What do you think the rich know that most people don't about inflation? Leave your answer in the comments below. And don't forget to like, comment, and subscribe for more wealth-building insights from BNR Blueprint.